In this video, we'll learn from the top 3 most successful traders in the world who ultimately went bankrupt. Investopedia refers to them as rogue traders, reckless traders who cause significant losses for the people or institutions that employ them. A trader might only be labeled a rogue trader after facing massive losses. But if they turn a profit, they're often hailed as geniuses and rewarded with bonuses. However, profits driven by sheer luck don't last forever. In this video, we'll delve into the stories of Nick Leeson, Bill Hwang, and Toshihide Iguchi, individuals once regarded as genius traders who later faced catastrophic failures in the market. We'll learn from their mistakes, which we can call the billion-dollar lessons, because there's often more to be gained from failures than from successes. Nicholas William Leeson was a derivatives trader from the UK. His failure in trading led to the collapse of Barings Bank in 1995, the oldest bank in the UK at the time. In April 1992, Barings Bank decided to open a futures and options office in Singapore, executing and clearing transactions on the Singapore International Monetary Exchange. And Nick Leeson was appointed as the general manager and licensed to operate in Singapore. That same year, through unauthorized trading, Leeson generated a massive profit of £10 million, contributing 10% of Barings' annual revenue. He was rewarded with a £130,000 bonus for his performance. However, as time went on, Leeson ran out of luck, and he began to accumulate significant losses. To conceal these losses, Leeson used a defective Barings bank account. This account was initially created to hide a £20,000 loss after a colleague mistakenly sold instead of buying a futures contract. He also used this error account to cover the losses of his colleagues who were known for their partying habits. By the end of 1992, the error account had recorded losses of £2 million, which ballooned to £23 million in 1993. In 1995, Leeson's losses skyrocketed to £208 million. Desperate to recover, he resorted to revenge trading, doubling down on positions after each loss in an attempt to cover his growing deficit. By this point, Leeson had transitioned from a trader to a gambler, risking client funds. This strategy had worked in the past, allowing Leeson to maintain his reputation as a genius trader. As his losses mounted, Leeson contacted Barings' headquarters in London, requesting additional funds. Trusting his reputation, they promptly sent the money. The tipping point arrived on January 16, 1995. When Leeson placed a short straddle, a high-risk options trading strategy where he simultaneously sold both a put and a call on the same underlying asset with identical strike prices and expiration dates. He bet that the Japanese stock market would remain relatively stable overnight. Unfortunately, the day after, a massive earthquake struck Japan, killing over 6,400 people. This disaster caused chaos in the Japanese and Asian markets, leaving his positions deep in the red. To cover these losses, Nick Leeson took several positions, betting that the Nikkei would recover quickly. However, this prediction turned out to be disastrously wrong. On January 23, 1995, Nick Leeson fled Singapore, leaving behind a note that simply said, "I'm sorry." By that time, Barings had incurred losses amounting to $1.4 billion and required a bailout. On January 26, 1995, Barings, the oldest bank in the UK, declared bankruptcy. Leeson fled to Malaysia, Thailand, and Germany before he was eventually captured in Frankfurt and extradited to Singapore in November 1995. Nick Leeson sentenced to 4 years in Changi prison. From a genius trader, he became a fugitive and convict due to his reckless trading activities. From Nick Leeson, we can learn a few important lessons. First, trust no one, because reputation can be manufactured. Profits may be shared, but losses are often hidden. So if someone claimed as a great trader, don't be tempted to hand over your money. Even the oldest bank in the UK went bankrupt by trusting someone's reputation. Second, psychology management is crucial for a trader. Revenge trading by doubling down on positions will only lead to faster bankruptcy. Our goal is to profit from trading, not to gamble with risky techniques. Third, remember that we're trading, not gambling. Gambling techniques won't work in the market. Bill Hwang, also known as Sung Kook Hwang, is an American trader. In April 2021, he went from having $20 billion to losing it all in just 2 days. How did that happen? Bill Hwang was once one of the most respected traders in America, rapidly building a strong reputation through Archegos Capital Management, which he ran with his small family. It wasn't just $20 billion, but also $10 billion in bank money that was lost. Now, Archegos Capital is considered one of the biggest failures in modern financial history. Bill Hwang's career and reputation, built since the early 2010s, collapsed overnight. No one has ever lost so much money in such a short time except Bill Hwang. He began his career at Hyundai Securities in New York before meeting Julian Robertson, where he helped manage the hedge fund founded by Julian Tiger Management until the early 2010s. Bill Hwang built his reputation through his stock-picking skills. In 2021, Hwang launched his own startup hedge fund with support from Julian Robertson. Robertson provided around $25 million to launch the Tiger Asia Management Fund. This fund grew to $5 billion before eventually collapsing due to the 2007 and 2009 recession. In 2012, Tiger Asia Management was investigated for using insider trading to trade Chinese bank stocks and was fined $60 million and banned from trading in Hong Kong for 4 years. In 2013, Hwang founded Archegos Capital, a family office managing Bill Hwang's own funds. At its peak, Archegos Capital had a portfolio of $36 billion, making Bill Hwang one of the wealthiest traders on Wall Street. On March 26, 2021, Archegos received margin calls from 4 banks, including Credit Suisse, Nomura Holdings, Goldman Sachs, and Morgan Stanley. Archegos had concentrated positions in a few companies like Viacom Cruise, Vipeshop, and Farfetch. From Bill Hwang, we can learn 3 important lessons. First, Bill Hwang was smart, but often smart people can be defeated by their own overconfidence and greed. Second, we learn the importance of money management and the dangers of over-leveraging in a single position. Even a trader with decades of experience can still fail to read the market and become overly speculative. Third, we learn not to use bank money or borrowed funds for trading. The next genius trader is Brian Hunter. Brian Hunter was a trader who specialized in trading LNG. In 2006, Brian Hunter's trading positions caused the hedge fund he managed, Amaranth, to lose $6.6 billion and go bankrupt. In April 2004, Amaranth reached out to Brian Hunter to expand its energy trading division. Traders specializing in LNG were rare, and the energy industry was booming. Brian Hunter accepted the offer and moved to Calgary, where 20 of America's LNG supply originates. With this reputation, Brian became more aggressive. According to reports, in 2006, 60 to 70% of the natural gas futures trading contracts were controlled by Amaranth. In that year, Brian analyzed that gas prices would rise during the winter. It made sense, as people use more gas to keep warm during the winter. His strategy was quite simple. Brian would take long positions before winter and short positions before autumn, but with extraordinarily large positions. In April 2006, Brian generated $2 billion in profit for Amaranth. However, the problem was that gas prices stopped rising and continued to fall, reaching $6 because gas companies were stockpiling gas in preparation for winter. Brian increased his positions, believing that prices would eventually rise with a total of 100,000 futures contracts. If there had been a natural disaster like a major hurricane, Brian would have made huge profits. Unfortunately, in September 2006, LNG prices continued to fall, hitting an all-time low of $5, and Amaranth ran out of money to add more margin. Brian had to close some of his futures contracts at a loss. Amaranth realized a loss of $560 million in a single day. When LNG prices reached $4, Amaranth was forced to sell its positions to Citadel and JP Morgan for $2.5 billion. From this deal, it's estimated that Amaranth suffered a loss of $6 billion. Surprisingly, after the deal, LNG prices skyrocketed by 80%. Just as Brian had predicted, JP Morgan and Citadel each made a $1 billion profit. Almost all loan traders made profits, except for Amaranth and Brian.